Today we are discussing General Electric Company, ticker GE. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. First up, this company has a market cap of $95 billion, enterprise value of $99 billion. So you see about $3.5 billion of net debt on this business, which is very insignificant in the overall enterprise value. They are operating in the industrial conglomerates business, which is a relatively rare thing these days. There's relatively few conglomerates left in the U.S. So they have a high-tech industrial company in Europe, China, Asia, Americas, basically the whole world, gas and steam turbines, upgrade and service solutions. They also have solutions for onshore and offshore wind services, manufacturing. They have a commercial and military aircraft engine business and a healthcare business as well. So you can see they have various financial solutions. GE has a huge financial component as well inside of it, life and health insurance projects, reinsurance, everything like that. Now, conglomerates are complex, and so that will complicate the financials that we end up seeing here because it's going to be a combination of everything from the whole company. So keep that in mind as we go through it. Conglomerates are very complex, and that can obviously complicate things. The first thing you're going to see when you look at this return on invested capital chart, certainly the first thing I see is that the peak here is 3.9%, and that was in 2003. Actually, I guess you have a peak in 2020 of 4%. But for the most part, you have a peak here. You were profitable every year up until 2014, and then the whole business looks like it changed. You lost money in 2015, made it in 2016. You had 3 years of losses from 2017 to 2019. You lost money again in 2021. So these businesses are totally different. From 2003 to 2014, you had a 12-year period of straight profitability, very, very stable. And yet then they started to lose money in 2015, and it became extremely cyclical. So it makes me think, what happened here? What's going on? From my understanding of GE, they were doing some sort of management of the earnings and basically hitting EPS targets very precisely. That's why you see this very predictable return on invested capital. But then once new management came over and take over, you started reporting massive losses. You started getting hit by some of these things that they had done early on that were affecting them in very bad ways. That's what you see here, and this is a very classical look of how a business can go wrong if they manage an EPS too closely of a target. One thing that's important here is these were not outstanding returns on invested capital. It's not like you were hitting 10, 15, 20% returns on invested capital. These were relatively poor returns on invested capital for a long period of time. So it wasn't like this was a screaming great business, even through the period that GE is known to have had apparently a really good business results. These are not screamingly high returns. And likewise, since then, this looks like a business you would completely avoid. Only 2 years of profits in the last 7 years. I guess you can count a profit in 2022. Likewise, when we look just down here at revenue, you can see revenue peaked in 2016 at $119 billion, and now it's down to $76 billion. Now, I do believe they've divested some businesses since then. That does throw a little discrepancy in there. So we're going to have to really look on a per share basis when we get into the financial statements. But for the most part, this is going to be a very difficult to analyze business, which is typically something most investors would be worth avoiding. But perhaps we can learn something from some red flags and some things you might want to know to avoid in the future. Overall, if this wasn't enough to make you want to avoid the company, you look at the 10-year median returns and you see that they are all negative. Negative returns means shareholders are not in a good place and you can only make money from a turnaround. That's not something that I'm ever interested in, so immediately I know this is not going to be a watch list company for me. There's nothing wrong with the margins here. 27% is relatively low, but again, as a conglomerate, it's combining so many different things there that it's really hard to tell. Likewise, these 10-year CAGRs on revenue, assets, and free cash flow. The fact that you have lower revenue today than you did 10 years ago is a relatively bleak sign. Likewise, again, you did have divestments here, so what you would want to see is, okay, even though you divested something, maybe you have a better per share earnings or something like that. But we don't see that here. You earned $10 per share in 2013, $12 in 2014, and you've never gotten anywhere close to that. Likewise, these losses have been very, very big. You lost $5 per share in 2015, $8 in 2017, $20 in 2018, $5 here. So, I mean, these cumulative losses are like $30, $40, $50 per share of losses over these periods. Very large amounts of money on a per share basis, especially when you consider the company's only trading at an $86 per share rate. So like $86 per share means that in 2018, you lost 20% of the current size of the business. That's massive. Massive losses on an EPS basis. Now, on an operating profit basis, it looks like they made money. So you had these just really big write-offs and things like that. Really big losses here, though, that is just quite poor to see. You don't see really good numbers here anywhere, and that's a big concern for me. Likewise, the PE here is astronomical, and it's because they're reporting very, very low EPS over the last year. The problem that I have is, how do you evaluate a business when you don't know the EPS on a normalized basis? You only made real money in 2016 and 2020. Let's see what they made then. You had $6 in EPS in 2016, and they were paying a bigger dividend than their EPS then. So that's a red flag. 2020, they earned $4.63, and they paid a 32-cent dividend. So $4.63, besides the fact that they lost money in like 5 years around that, even at $4.63, you're trading at like a PE of 18 or 19 or 20. That's not cheap, and that's ignoring all these other losses. So this company is clearly, it still looks like extremely overvalued, because we have no record here that says that any sort of recent history involves making a lot of money, but in fact, a lot of history of losing a lot of money. So very bad here from the numbers. If you're learning something, if you're enjoying this, even if you don't like this company, please consider liking this video, because I hope you'll learn something as we work through what looks like a relatively bleak business for something that has a great brand name historically. It's certainly not done as well recently. Now, one thing that's interesting, of course, is you have been profitable on a gross profit basis every year for the last 10 years. That's a good sign. If this ever tipped negative, that would be a very major concern. Likewise, although you lost money in 5 of the last 10 years on a bottom line basis, you had negative operating profit only in a single year. That was 2017. That's a key piece, because that means that the business is doing better than it otherwise would. You'd have a lot of one-time items, or perhaps interest expenses or write-downs, things like that could cause you to have those big losses. And you do see this here. There's a lot of, very many years here from 2014 to 2021, you have other non-operating income that is quite negative. $2.7 billion, $3 billion, $2 billion, $4 billion, $23 billion, $4 billion. Now, you made a little bit of money here in 2020, but $6 billion in 2021. The only reason you even made any money in 2020 is because these other non-operating incomes. So some really major concerns here with these really big loss numbers. And that's completely ignoring the massive amounts of interest expense that was hosted on this business, and it was trying to sustain. Now, the first positive sign here is the shares outstanding. Your shares outstanding have declined over time from 1.2 billion to 1 billion. So you've decimated about 20%, 20 to 25% of the shares outstanding over the last decade. That's going to improve your EPS growth by about 2% a year. But your net income has collapsed. You were making $13 to $15 billion, and now you're making nothing. And that's a major concern when you try and think about what is this business worth? If you value it on, $225 million, then of course it's trading at this astronomical 424 PE. That's probably not the right way to think about it. But can you really use the $5 billion here or the $7 billion here when you have these massive losses in between? I don't think you can. And so it's really worth it, especially when you think about the fact that in 2020, this $5.7 billion net income did not come from operating profit. It was non-operating numbers. So just something to be aware of there, that the income statement's not helping me get any more excited about this business. One other thing I want to on the income statement, you began the decade with basically $18 billion in SG&A. You end at $15 billion in SG&A. So your SG&A declined by about 15 to 20%. But your revenue declined substantially more than that. You were at $119 billion. You're now at $76 billion. So you've lost somewhere in the range of 30 to 40% of your revenue, which is way worse than the ability that you've had to reduce your SG&A. So if you've reduced your SG&A faster, maybe the business would be doing a little better, but that's not what we see here. Now, balance sheet. Key point here is they don't have a lot of net debt compared to what they used to have, and you can clearly see that. They had $258 billion in net debt in 2012, and they're down to of debt in 2012. They're down to 28 billion. That's actually a really good sign, because one of the things that caused them a lot of problems was all of this interest expense. And as interest rates are rising now, it'd be really good for them to have paid down that debt, or at least spun off some of that debt. So I am glad to see that. And when you offset this $28 billion in debt against the $17 billion in cash, that's showing some value there in terms of they don't have as much net debt as you otherwise might think you might have. They do have these pension liabilities, which have been going down, but I'm always concerned with pension liabilities because they tend to be understated. And so that would be something to really check in before buying stock in a company like GE is, this $16 billion in pension liabilities, is that real? Is it really 20? Is it really 30 or 40? You really need to understand what those pension liabilities are going to be. That's not something you want to see on a balance sheet for a company that you'd be investing in today. You can see the overall liabilities have absolutely been collapsed on this business. They've really shrunk the size of this business. 684 billion assets to 187, 556 billion to 150 billion. This is a much smaller business today than it used to be. In that sense, your actual returns on the underlying assets is probably getting better if they can actually turn around the income statement, because they've collapsed. The revenue has gone down 30 or 40%. But the balance sheet is down like 80%, which means that if they can turn this business around, you could have a good business at the end of it. But you can clearly see they've tanked their retained earnings because of all these losses. And so it's just a really different business today than it used to be when you were stable over a decade ago. Now, cash flow statement. Cash from operations was positive every year. This is a very good sign that they weren't in imminent concerns necessarily of bankruptcy. They were able to maintain their positive cash flow from operations despite all of these net income losses that you had. So that's a very good thing for them. You can see that they haven't having to, they had some negative free cash flow because you could see PP&E above cash flow from operations in some of the years. But that is a lot of cash that they were able to have there. You see that they've had to, they had some pretty big buybacks here. They've been paying down debt massively over the last decade, which is very, very good for them to be able to get in a much better situation. This business probably needs to operate without debt until proven otherwise because of how it's been handled in the past and just how much value destruction has occurred with those massive losses. Dividends are relatively low compared to everything else. No problem there. And even the buybacks, I'd really want to stop the buybacks and the dividends till I get this debt gone, manage this business very differently than it was in the past. Until then, I think this company is uninvestable. I mean, GE is a company that I almost bought stock in the past. Maybe I have bought it, but I certainly considered it in the past. There were times I thought it was going to be a really great deal. But I mean, to be trading at $100 billion enterprise value and they're not making any money, you have a significant amount of debt. This history here is so cyclical and so many losses, 5 years of losses, some of them quite large, that I would simply avoid it until this business can get turned around, put in better shape, hopefully a clean balance sheet with no debt, and maybe in the future it could be investable. But right now, you don't have the greatest history. Your returns are quite poor even before they had this recent period, and you need to get this company down with probably even lower assets and hopefully get those returns going the other direction. Until then, I'm going to pass on General Electric. I hope you learned something. Please hit that like button. Don't forget to subscribe. And if you want to see the companies I like, my playlist for my watch list stocks is at the top. I hope you'll check those out. And if you want to learn about this type of software that I'm using, it is quickfs.net. My affiliate link is first description in the description below. Great way to support the channel is using that link to sign up. Free or paid account. Great way to do so there. Thank you for listening. Until next time, stop paying fees, start building wealth.